Picture this. You're sitting at a red light on a Tuesday afternoon, and your phone buzzes with a notification from your insurance company. Your 6-month policy is up for renewal, and your premium is increasing by 12%. You stare at the number trying to figure out what changed. You haven't had an accident in 8 years. You haven't gotten a speeding ticket in over a decade. You drive a sensible sedan, not a sports car. You take the same route to work every day. You're literally the safest driver you know, the person everyone calls boring because you actually go the speed limit and use your turn signal every single time. So you call your insurance company to ask why your rate went up, and the customer service rep gives you some vague explanation about risk factors and market conditions and actuarial tables. You press for specifics, and they tell you it's based on your profile. Your profile. You're a perfect driver, so what profile could possibly justify a 12% increase? What you don't know is that your coworker who rear-ended someone last year just got his renewal and his rate only went up by 3%. Same insurance company, same city, same coverage levels, but he caused an actual accident and he's paying less than you. The only difference? He lives in a different zip code, went to college, and has a higher credit score even though none of those things have anything to do with how safely you drive. My name is Alicia, and I spend way too much time exposing the supposedly objective systems that extract money from people who can least afford it while pretending it's all based on data and fairness. If you've ever looked at your insurance bill and felt like something wasn't adding up, or if you've been told that insurance rates are purely about risk when your perfect driving record suggests otherwise, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you will completely change how you think about car insurance. Most people believe that car insurance rates are determined by how you drive. Makes sense, right? The whole point of insurance is to cover the risk of accidents. So safer drivers should pay less and riskier drivers should pay more. That's the deal we think we signed up for. You drive carefully, you avoid accidents, you follow the law, and you get rewarded with lower rates. Except that's not how it actually works, and the insurance industry has spent millions of dollars making sure you don't understand the real formula they're using to calculate what you pay. Let me introduce you to Marcus. He's 38 years old, works as a delivery driver, and has been driving for 20 years without a single accident. Not one. 0 speeding tickets, 0 fender benders, 0 insurance claims of any kind. His driving record is so clean, it's basically invisible. He drives a 2015 Toyota Camry with 120,000 miles on it, nothing fancy. And he's had the same insurance company for 6 years because he's heard that loyalty gets you better rates. Last month, Marcus got his renewal notice and his premium jumped from $140 a month to $173. That's a 23% increase in 1 year. $33 more per month, which is $396 more per year for a driver who has never cost his insurance company a single dollar in claims. Marcus called to ask why, and the representative told him his rate was adjusted based on updated risk modeling. When he asked what risk they were modeling since he'd never had an accident, they said it was based on multiple factors including his credit score, his zip code, and his profession. His credit score, his zip code, his profession, none of which have anything to do with how safely he drives, but all of which are perfectly legal for insurance companies to use when setting rates. And this is where the scam becomes visible, because these factors aren't random. They're systematically designed to charge more money to people who are already getting squeezed by every other part of the financial system. Think about what Marcus just learned. The insurance company looked at where he lives, what he does for work, and what his credit report says, and decided that makes him a higher risk driver than someone who actually caused an accident. That should make absolutely no sense, but it makes perfect sense when you understand that insurance companies aren't actually pricing based on driving risk. They're pricing based on what they can get away with charging you. Let me show you the numbers that prove this isn't about safety. A 2022 study by Consumer Reports analyzed 2.3 billion car insurance quotes across every major insurer and found that drivers with excellent credit pay an average of 68% less than drivers with poor credit, even when controlling for driving record. 68%. Same car, same coverage, same accident history. But if your credit score is below 650, you're paying almost 70% more than someone with a score above 750. Now explain to me how someone's credit score predicts whether they'll run a red light. Explain how paying your credit card bill late makes you more likely to cause an accident. It doesn't, and the insurance companies know it doesn't, but they use credit scores anyway because the correlation they actually care about isn't with accidents, it's with price sensitivity. People with lower credit scores have fewer options, less ability to shop around, and less ability to pay up front for 6 months of coverage to get the discount, which means insurance companies can charge them more without losing their business. The same study found that zip code had an even bigger impact on rates than driving record. A driver with a perfect record living in a predominantly Black or Latino neighborhood can pay more than a driver with a DUI living in a predominantly white suburb. Let that sink in. You can have never had an accident, never gotten a ticket, drive the safest car on the market, and you'll still pay more than someone who drove drunk if you live on the wrong side of town. Marcus lives in a zip code that's 72% Black, median household income $43,000, and his insurance is 59% higher than the rates for identical coverage in a zip code 15 minutes away. That's 81% white with a median household income of $78,000. Same city, same insurance company, same coverage. But because Marcus lives where he can afford to live, he pays 59% more. Over 10 years, that's thousands of dollars extracted purely based on where he lives. Occupation is the third piece of this puzzle, and it's just as arbitrary as the other factors. Insurance companies charge different rates based on what you do for work, supposedly because certain professions correlate with different risk levels. Sounds reasonable until you see what actually happens. A study from the Consumer Federation of America found that insurance companies charge professionals like doctors and lawyers significantly less than they charge service workers like delivery drivers and warehouse employees, even when controlling for income and driving record. Marcus is a delivery driver, which means he's on the road more than most people, and you might think that justifies higher rates because more time driving equals more exposure to risk. Except his coworker James is a software engineer who commutes the same distance every day and works from home 2 days a week. So he's actually driving less than Marcus, but James pays 41% less for insurance. Same number of miles driven per year, same perfect driving record, but James has a job that's coded as lower risk because he wears a button-down shirt to work instead of a uniform. Add all these factors together and you start to see how the system works. Marcus has a credit score of 635 because he had some medical debt that went to collections 3 years ago. He lives in a zip code that insurance companies have decided is high risk based on claims data that may or may not actually reflect his individual risk. He works as a delivery driver, which insurance companies have coded as a higher risk profession even though he's never had an accident. None of these factors predict whether Marcus will cause an accident, but all of them predict that Marcus can be charged more without switching companies. Think about what this means in actual dollars over Marcus's lifetime, because the compounding effect is genuinely staggering. Marcus is paying $173 per month for car insurance. His coworker James, with the identical driving record but better credit, whiter zip code, and white-collar job, is paying $98 per month with a different company. That's $75 more per month that Marcus pays for the same coverage. Over a year, that's $900. Over 10 years, that's $9,000. And that's assuming the gap doesn't widen as insurance companies continue adjusting their algorithms. $9,000 that Marcus could have invested, could have used to improve his credit score, could have saved for a down payment on a house in a different neighborhood where his insurance would be cheaper. Instead, it goes to an insurance company as profit because they've figured out they can charge him more and he probably won't leave because switching is a hassle and all the other companies will charge him similar rates based on the same discriminatory factors. But wait, there's more. Because we haven't even talked about how insurance companies manipulate the concept of discounts to make you think you're getting a deal when you're actually just paying less of a penalty. Insurance companies advertise things like good driver discounts, safe driver discounts, accident-free discounts, and they make it sound like you're being rewarded for safe driving. Marcus gets a 15% good driver discount, which sounds great until you realize that the base rate they're discounting from is artificially inflated based on all those other factors we just discussed. What actually happens is that insurance companies set a baseline rate that's higher than it needs to be. Then they offer discounts to make you feel like you're getting a deal. The good driver discount isn't a reward for driving safely. It's just removing part of a penalty that shouldn't exist in the first place. Marcus is getting 15% off a rate that's already 59% higher than it should be based on where he lives. So he's still paying way more than someone in a different zip code who drives worse than he does. There's also the loyal customer penalty, which is one of the most insidious parts of this whole system. Insurance companies know that most people don't shop around for insurance every year because it's time-consuming and annoying, so they reward new customers with low introductory rates to get them in the door, then gradually increase those rates every year, betting that you won't notice or won't bother switching. A 2021 study from the National Bureau of Economic Research found that customers who stay with the same auto insurer for more than 6 years pay an average of 23% more than they would if they switched to a competitor. 23%. Marcus has been with his insurance company for 6 years because he thought loyalty would be rewarded, but he's actually being punished for it. He's paying $173 per month when he could probably find the same coverage for $133 if he spent an afternoon getting quotes from 5 different companies. That's $40 a month, $480 a year, just gone because he trusted that staying with the same company was the smart move. The historical context makes all of this even more infuriating because using zip codes and credit scores to determine insurance rates isn't some new innovation based on modern data science. It's a way of continuing redlining without explicitly mentioning race. From the 1930s through the 1960s, insurance companies could legally refuse to sell policies to Black people or charge them more explicitly based on race. When that became illegal in 1968, the industry found new ways to achieve the same outcome using supposedly race-neutral factors that just happened to produce the same racial disparities. Zip code is the most obvious example. Neighborhoods are still segregated in America largely because of redlining and discriminatory housing policy. So when insurance companies charge more for certain zip codes, they're effectively charging more based on the racial composition of that neighborhood. They can claim it's about claims data and risk modeling, but when the zip codes with higher rates are disproportionately Black and Latino neighborhoods, even after controlling for actual accident rates, at some point you have to acknowledge what's actually happening. Credit scores work the same way. Black and Latino families have lower average credit scores than white families because of the racial wealth gap, which exists because of housing discrimination and employment discrimination and every other form of systemic racism that has limited wealth accumulation for generations. So when insurance companies use credit scores to set rates, they're punishing people for being victims of discrimination while pretending it's just objective risk assessment. Let me tell you what happened to the real Marcus, the person I actually know who figured out he was getting scammed. He spent an entire Saturday afternoon getting quotes from 12 different insurance companies, which is way more than most people would do, but he was angry enough to put in the work. What he found was genuinely shocking. Rates for the exact same coverage ranged from $118 per month to $247 per month. Same car, same driver, same coverage limits, but depending on which company he chose, his annual cost could be anywhere from $1,416 to $2,964. That's a $1,548 difference per year, based purely on which company he picked, and none of it had anything to do with how safely he drives. The cheapest company was one he'd never heard of, and when he called to confirm the quote, they asked about his education level. He told them he had a high school diploma and some community college, and the rate immediately jumped by 18%. He asked why, and they said education level is a rating factor in their state. He asked what his education has to do with how safely he drives, and the representative gave him the same vague answer about risk modeling and actuarial tables. Marcus eventually found a company that would give him the same coverage for $128 per month, which is $45 less than he was paying. That's $540 per year he was overpaying. $540 that was being extracted as a poverty tax because his previous company knew they could get away with it. But the process of finding that rate took him 6 hours of comparing quotes and reading policy documents and calling customer service lines. And that time has value too. 2 years later, Marcus is still with that cheaper company, and his rate has crept up to $149 per month, even though he still has a perfect driving record. The loyal customer penalty is kicking in again, which means he'll need to shop around again soon if he wants to avoid getting gouged. This is the exhausting reality of being a perfect driver in a system designed to extract maximum money from you. You have to constantly fight just to avoid being overcharged for something you're legally required to have. Think about the perverse incentives this creates, because insurance companies make more money when they can segment customers and charge different prices for the same product based on factors that have nothing to do with actual risk. They spend millions on lobbying to keep credit scores and zip codes and education levels legal as rating factors because those factors allow them to charge more to the people who have the least ability to fight back. Meanwhile, they spend millions more on advertising to convince you that insurance is all about safe driving and accident history when those factors are actually less important than where you live and what's on your credit report. The most frustrating part is how this system hides behind the language of data and objectivity. Insurance companies will tell you that their actuarial models have determined that people with lower credit scores are more likely to file claims, and they'll show you correlations in their data that support this. But correlation isn't causation, and even if there is some correlation, that doesn't mean it's fair or appropriate to use credit scores as a rating factor. What the data actually shows is that people with lower credit scores are more likely to file claims because they can't afford to pay for small repairs out of pocket, so they use their insurance for things that wealthier people would just pay for themselves. The credit score isn't predicting riskier driving, it's predicting financial vulnerability. Insurance companies are using that financial vulnerability to justify charging more, which makes the financial situation worse, which leads to more claims, which justifies higher rates in a vicious cycle that keeps people trapped. Calculate what you're actually paying versus what you could be paying, because the difference might be shocking. Go to at least 5 different insurance company websites right now and get quotes with identical coverage. Put in your real information and see how much the rates vary. If you find something significantly cheaper, switch immediately. There's no reward for loyalty in this industry, only penalties. Challenge the rating factors if you can. Some states have banned or limited the use of credit scores in insurance pricing. California, Hawaii, and Massachusetts don't allow it, and other states are considering similar laws. If you live in a state where credit-based insurance scoring is legal, contact your state insurance commissioner and your state legislators and demand that they ban the practice. There's no good reason why your credit history should affect your car insurance rates, and the only reason it's still legal is because insurance companies have more lobbyists than you do. Improve your credit score if possible, not because it's fair that insurance companies use it, but because it's the reality you're living in. Pay down high-balance credit cards, dispute errors on your credit report, set up automatic payments so you never miss a due date. Every point your credit score goes up can potentially save you hundreds of dollars per year on insurance, which is absurd but true. Consider moving if the insurance savings justify it, though I recognize that's not realistic for most people. But if you're already considering moving and you're comparing neighborhoods, factor in the insurance costs for each zip code. A place with $50 per month cheaper rent might actually be more expensive if insurance is $75 per month higher. The total cost of living in a neighborhood includes the insurance penalty you'll pay for living there. Bundle your policies if it actually saves you money, but don't assume it does. Sometimes buying separate policies from different companies is cheaper than bundling with one company. The insurance industry trains you to think bundling is always better, but that's just marketing. Do the math every single time. Shop around at least once a year, ideally right before your renewal. Set a calendar reminder, block out an afternoon, and get quotes from at least 5 companies. The loyal customer penalty is real, and the only way to avoid it is to constantly threaten to leave. It's exhausting, and it shouldn't be necessary, but that's the system we're living in. Join advocacy organizations fighting for insurance reform. Groups like the Consumer Federation of America, Center for Economic Justice, and United Policyholders are pushing for regulations that would ban discriminatory rating factors and require more transparency in how rates are set. The more people who join and support these efforts, the more pressure there is on legislators to actually do something. The insurance scam exists because we've allowed companies to use factors like credit scores and zip codes that have nothing to do with driving safety, but everything to do with extracting maximum profit from vulnerable populations. Marcus pays more, even though he's a perfect driver, because the system isn't designed to reward safe driving. It's designed to identify who can be charged more without leaving. Every driver with a perfect record who's paying inflated rates based on their credit score or their neighborhood or their education level is being robbed in slow motion. And the robbery is legal because the insurance industry has successfully convinced regulators that discriminatory pricing is actually just sophisticated risk assessment. Your insurance rates have almost nothing to do with how safely you drive and almost everything to do with how successfully insurance companies can segment you into a demographic they can overcharge. That's not a bug in the system, it's the entire business model. The question is whether you're going to keep paying the poverty tax or whether you're going to fight back by shopping around, demanding reform, and refusing to accept that any of this is normal or fair.